Is the $2.7 billion bank aggregation boom unlocking unstoppable global power? You know that feeling when you open your banking app and wish all your accounts, your main one, your savings, maybe even your investment portfolios, could just talk to each other? Imagine having every financial detail, every transaction, every balance in one clean, unified dashboard. No endless tabs. No spreadsheets. Just crystal clarity. Well, that's no longer a dream. It's becoming a massive global business movement, and the numbers behind it are wild. Welcome to L-Impact Solutions Podcast. I'm your host, and today we're diving into the booming world of bank statement aggregation, a market that's quietly reshaping how individuals, businesses, and financial institutions manage money, data, and trust. Let's start with a stat that might make you blink twice. The global bank statement aggregation market generated around $2.7 billion in 2024. Sounds solid, right? But wait for this. It's expected to grow from $3.3 billion in 2025 to roughly $21.6 billion by 2034. That's a compound annual growth rate of 23%. For context, that kind of growth isn't just impressive, it's explosive, especially for a financial infrastructure sector. So what's bank statement aggregation all about? Let's break it down in plain language. In essence, it's the process of automatically collecting financial data, like transaction records, balances, and cash flows, from multiple bank accounts and sources, then presenting it in a single, unified view. Think of it as money management on steroids, powered by secure APIs and advanced data integration tools. Now, API stands for Application Programming Interface. Picture it as a digital handshake between apps, a way for your banking platform, your accounting tool, or even your tax filing service to securely, automatically share information without the need for manual uploads or complicated exports. It's basically what lets a small business see real-time cash positions across all accounts or enables a fintech app to track users' spending habits live. Back in 2010, this kind of automated data flow was rare. Banks were cautious, systems were closed, and regulators were figuring out how to handle digital finance. Fast forward to today, and bank statement aggregation is not just a convenience, it's a critical foundation for the entire fintech ecosystem. Let's talk geography for a second. In 2024, North America led the charge, capturing over 36.4% of the global market, equating to about $0.99 billion in revenue. Why North America? A few reasons stand out. First, the region's fintech penetration is enormous. Think of players like Plaid, Yodlee, and Finicity, companies that have spent years building secure bridges between banks, payment platforms, and budgeting tools. Second, American consumers are more accustomed to digital finance innovations, from mobile payments to robo-advisors. And third, the U.S. regulatory framework, while complex, has largely favored open banking initiatives, creating room for collaboration and innovation. But we can't ignore the rest of the world here. Europe, for example, has been pioneering open banking under the PSD2 directive, which pushes banks to share data securely with third-party providers, with customer consent, of course. This has allowed fintechs in places like the UK, Netherlands, and Germany to thrive. Meanwhile, Asia-Pacific markets, think India, Singapore, and Australia, are catching up fast, driven by digital payment growth and governments encouraging financial inclusion. So yes, North America currently dominates, but that picture may shift. Over the next decade, emerging economies might leapfrog traditional markets, largely because they can integrate new technologies without being tied to legacy banking systems. Now let's zoom in on why this growth curve is so sharp. What's fueling this giant leap from $3 billion to $21.6 billion in just about a decade? For starters, there's the explosion of digital transformation across every sector, from retail banking to insurance to real estate. Companies are realizing that manual financial processes are not only inefficient but also risky. Aggregation tools simplify everything, from loan underwriting and credit risk assessment to cash flow forecasting. If you're a business owner listening right now, think of how many hours go into pulling bank statements for audits or reconciliations. With aggregation technology that can happen in real time, automatically, and securely. For financial analysts and lenders, that means faster approvals. For accountants, it means fewer errors. For customers, it means smoother experiences. Another driver is the growing use of artificial intelligence and data analytics in finance. These algorithms rely on large, high-quality data sets to make accurate predictions. Bank statement aggregation feeds AI models with exactly that clean, continuous, real-time financial data. For example, a digital bank could use aggregated data to automatically offer better interest rates or tailor insurance products to specific spending behaviors. But here's an interesting twist. This boom isn't just about technology. It's also about trust. As banking becomes more digitized, customers expect transparency and control over their data. Aggregation systems are designed around consent and security, often using encrypted APIs that protect user privacy while still enabling insights. The key challenge, and perhaps the greatest competitive differentiator, is maintaining that balance between data utility and user confidence. When you think about it, the entire financial world is moving toward visibility, knowing where your money is, how it moves, and what it can do for you. Aggregation makes that visibility possible across fragmented systems. Now, let's talk about who's winning in this space. You've got traditional data aggregators like Yodlee and MX, powerful fintech startups like Plaid, Tink, and TrueLayer, and big cloud players like IBM and Oracle who are stepping into financial data infrastructure. The competitive landscape is heating up because the opportunity is not just in providing the data, it's in building ecosystems around it. Aggregation is becoming the foundation for services like digital lending platforms, personal finance apps, and business automation solutions. And as financial ecosystems expand, banks are realizing something huge. Instead of competing head-on with fintechs, collaboration can be far more profitable. That's why we're seeing more open banking partnerships and joint ventures centered around aggregation. The banks bring trust, customer bases, and compliance know-how, while fintechs bring agility, speed, and user experience expertise. But let's not get too starry-eyed. Every innovation brings its challenges. Security breaches, data misuse, and unauthorized access remain big concerns. One serious data leak could erode consumer confidence in the entire industry. Regulators know this and are tightening guidelines for how financial data is shared and stored. Europe's GDPR and the US's evolving Consumer Data Privacy Acts are setting global standards. Companies that get compliance right will gain an early advantage. Another challenge is interoperability. Even though aggregation depends on APIs, not all APIs speak the same language. For example, one bank might send transaction data in one format, while another uses a different schema. Harmonizing that data takes engineering finesse, and for small fintechs, that can be expensive. But this challenge is also an opportunity. Standardization can unlock new efficiencies and market scalability. So what's next? If the market reaches that projected $21.6 billion by 2034, what kind of ecosystem will we be looking at? My prediction: we'll see a future where financial visibility is as seamless as social media. You'll open one app that shows your total financial health, your checking accounts, loans, crypto, taxes, investments, updated by the second. Your AI-driven financial assistant might tell you when to move money, invest, or pay down debt based on your aggregated data. Essentially, finance becomes fully personalized, predictive, and proactive. For small businesses, this could be transformational. Imagine your accounting software automatically reconciling transactions across multiple bank accounts, generating cash flow forecasts, and suggesting cost optimizations, all powered by aggregated data. Finance departments won't spend time gathering information. They'll spend time making decisions. That's powerful. Investors are taking note. As this technology matures, venture capital funding for data infrastructure startups is rising. Private equity firms are also eyeing acquisition opportunities, looking to integrate aggregation capabilities into broader fintech portfolios. From a consumer perspective, this growth might even change how people perceive banking relationships. In the past, loyalty was tied to one bank. In the future, loyalty might shift toward the platform that gives the best aggregated experience. the one that brings every account and product into one seamless space. We might even see a point where the super app model, popular in Asia through companies like Grab and WeChat, becomes standard in the West, but focused on financial aggregation. Imagine one platform that's part bank, part investment advisor, part accountant. The ripple effects touch nearly every sector. Insurance companies using aggregated data to assess claim risks faster, lenders approving mortgages in minutes instead of weeks, and even governments using anonymized financial data to understand economic behavior patterns more accurately. Still, amid all this optimism, the road ahead requires careful oversight. The question isn't just how fast we can aggregate, but how responsibly we can manage the wealth of information that aggregation creates. Ethical data use will separate the winners from the rest. In the end, bank statement aggregation isn't just about convenience or software. It's about empowerment. It's about giving people and businesses more clarity in a complex financial world. The same way search engines organize the internet, aggregation is organizing finance. So, as we wrap up today's discussion on this fast-growing market, expected to jump from $3.3 billion in 2025 to around $21.6 billion by 2034, I want to leave you with a question. If financial data aggregation gives individuals control and visibility like never before, does that make banks the new data custodians? Or should that power belong solely to consumers? I'd love to hear your thoughts in the comments below.